Thank you for joining us for vlog number 2. Last month we discussed why we are bootstrapping an option firm, what are the ups and downs we're going through, and how we're trying to figure out a work-life balance. This month we're going to show you the different events that we held in June and try to give you an extended version of those events so you can kind of get an understanding on the type of events that we conduct. So let's jump into the extended version of the events that we held in June. Options are contracts called puts and calls. A standard put or call represents 100 shares if you're trading stock options. Options can be bought and sold at different standardized strikes on an options chain. All options have an expiration date. When you buy a call, you want the underlying to go up. So you want it to go up, like when you're buying stock, you want it to go up, right? And it's a debit outside of your account, in your account. So if you have $1,000 in your account and buying a call is $100, you're now going to have only $900 available to you, okay? So when you buy a put, you want that underlying to go down. And I say underlying, I just mean the stock, okay, or whatever you're trading. You want it to go down if you buy a put. When you sell a call, you want the underlying to go down. So, and you're receiving a credit into your account. So using an example again, if you had $1,000 in your account, now, and if you sold something for a call for $100, now you have $1,100, $1,100 in your account now, okay? You literally have that in your account immediately. You're trading on a platform like TastyWorks or Thinkorswim, you'll see that in your cash balance immediately. So, and this last one is when you sell a put, you want the underlying to go up. So it's the opposite of buying a put. When you buy a put, you want it to go down, it's a debit. When you sell a put, you want it to go up, it's a credit. Once again, that credit is into your account immediately. And I only recommend that you use an index when you are new because you don't want to have to deal with earnings and you don't want to have to deal with CEOs going crazy or something going wrong with a stock, right? Like recently we had a situation with Boeing, right? There's nothing you can control. Boeing's a great company and so forth, but they had the plane situation and the stock tanked, right? It hasn't recovered yet and it's dealing with all this tariffs and there's a lot of uncertainty around the company. I hate stuff like that, right? I like to just deal with indexes so that I don't have to have that outside stuff. Trading is already hard, right? So why would I want to deal with stuff that's going to make it harder, right? But if you're not a beginner, you might love trading stocks. So you can execute it, right? You can do that, right? It's fun trading earnings and all that kind of stuff. But I don't trade options for fun. I enjoy it. It's one of my favorite things to do, right? But it's not about excitement to me. It's only about making money. I don't care about the excitement on it. If I wanted excitement, I would go to an amusement park or, go watch a movie or whatever. But it wouldn't be trading options. But some people get in for excitement. So selling at the 10 delta is too boring for them, right? They want to sell something very, very closer to that money. They want to sell naked things and so forth. As a beginner, I don't recommend you selling something, a naked call or a naked put, because you don't know how to adjust. You don't know how to fix that when it goes wrong. Things go wrong, right? An insurance company, when they insure somebody, they know eventually someone's going to get in an accident, right? So they have to prepare for that. And when you're selling options, eventually you're going to have a problem option. And you're going to have to fix it. Just like what's going on with you this week, right? You put on some stuff, it's going to be a problem. So, but if you are experienced and know how to adjust, you can turn that problem into a victory, right? You can turn it into a win. So I just arrived at a Talk and Trade event that I'm holding today at a Black Walnut Cafe. The Talk and Trade is about just coming out, talking and trading, talking about cryptocurrencies, talking about bonds, obviously talking about options, talking about whatever is going on in the markets. Like right now we got tariffs going on with Mexico and China. So that is what the Talk and Trade event is about. It's in the Sugar Land area of Houston and about to get it started. Talk and Trade is going to start in about an hour. I like to get here early, kind of follow the markets, the futures, and kind of get myself settled because the Talk and Trade is literally the whole time the market is open from 8:30 to 3 p.m. Central Standard Time, and normally we have people here talking the whole time, so it's a really exhausting event for me because I never stop talking until the whole time the market is open. But it's an awesome event for people to get to hang out with different traders and get to learn different philosophies and just to be able to hang out with like-minded people who are interested in options, who are interested in the markets. We normally jump into introducing ourselves, but tonight we have a lot of information, so we're actually going to move on for a second and jump into a game, a quick game. And this game is called What is Better? What is better? So, just for example, before I present this question, what is better? You heard the old saying, a bird in your hand is worth two in the bush, right? So are you that type that prefer having one bird in your hand, or are you that type that prefer to go get the two birds in the bush? Do you want to eat now, or do you want to have a feast by going and get the birds in the bush? For me, I would prefer having the bird in my hand because it's guaranteed. I guarantee to get to eat it, right? But that's just my temperament. That's my personality. Someone else might have a little bit more risk. It might be a little bit more aggressive. So they want to go after the two birds. Okay? So these type of questions are subjective to a certain extent based on your temperament. Okay? I mean, if you sell something at the money, right? Let's say it's 100. It's at 100. And I'm trying not to use the whiteboard because we're going to go over this stuff tonight in detail. But if you sell something at 100 and you buy something at 100, right? You're both bullish. If it goes down, do you both lose? Yes. Okay? So, but if it goes down to 0, do you lose the same amount?
No.
And why not?
Because you're just, for the options, you're just buying, you're just going to lose whatever you bought them for.
So I'm talking about selling the option.
Oh.
Selling the option. So if you sell at 100 and you buy it, if you sell an option, and every option, let me step back for a second for everybody to understand. Every option equals 100 shares, right? So if a call option, one option equals 100, a put option, 1 equals 100. So if I sell an at the money put, I'm controlling 100, equals 100, represents 100 shares. If I buy 100 shares at the money, right, then obviously it's the same. So it's the same type of trade, but which one is better?
Well, you're saying buying 100, you're what? Buying a put?
No, I'm buying the shares.
Okay,
buying the shares.
Buying the shares. So I would rather just sell it because, well,
You're collecting premium, so you got to reduce that.
Well, not.
Jonathan, awesome. So that's the, what you're gonna say?
Now to clarify a little bit, if you sell that to money put, and that sucker drops, that's gonna get put to you, man.
So,
and then you're gonna have to purchase something that's going down.
Just in case it does
so
go down
it's
to 0.
the same. It's the same, but the probabilities, and I'll explain. Selling the at the money put is better because the probabilities are better. Now, let me explain why it's better. Right?
Compared to buying.
So let's say you have $10,000, right? Because 100 times 100 is what? 10,000, right? 100 shares equals each put equals 100 shares, right? So let's say you have $10,000 and you sell the at the money put, or if person A sells the at the money put. Person B buys the shares at the money for $10,000. Both have $10,000, right? Both have $10,000. One sells the put, the other buys the shares right away. The person who sells the put, they receive a premium for that right away, right? They receive premium. So let's use the same type of math I was saying earlier. Let's say you receive $300 to sell the at the money put, right? So when do you start losing? when do you start losing when you sell when you receive $300 and you sell that 100? When do you start losing?
In all this track.
No?
Because after that, right?
Call it
You
97.
have a little bit of insurance.
It drops lower
Then what?
than the strike price that you sold.
Yeah.
No.
Well,
Because
after the
because-
Well, it's gotta go down to 3.
it's got to go down 3.
Yeah.
So let me explain. So you sell the put at 100. You receive $300 in your account. You're an insurance company.
Oh, yes, sir.
You are the insurance company. So you don't start losing until it goes below 97. The person who buys the shares, they lose right away if it goes below 100. They have no buffer, right? So you both have the same risk. You both have $10,000, and you decide to allocate it, right? And tonight is about return on capital, right? What's the best way to allocate your capital? And it's always a more efficient way, especially using options, right? It's a more efficient way to do it. So in this case, if you sell a put, you receive the $300, you don't start losing until it goes past 97. So you have a 3% buffer, using that math as 100, right? So when you buy it at 100 shares, when you buy the shares at 100, you only have a 50-50 shot, and it only can go up, okay? That's the only way you win if it goes up. If it goes down, you lose immediately. Yeah, and I'm sure we've all experienced that buying stock before. We buy it, it goes down right when we start buying it. And that, that's a bummer.
It's just like the car insurance company who I'm paying every single month, and unless they pay out, they're making money every single month. Right?
Correct.
That's intrinsic value.
And using the car insurance example, they have a buffer, right? So they have the insurance, they have the premium you pay them, right? And they have the deductible that they require. So they have a buffer, right? So you can get in a car accident and say that you paid them $1,000. You can get in a car accident for $1,000. They still don't lose, right? They just break even on that, right? And if you have the deductible, they actually make money on it because they make money off. You have to pay the deductible, so let's say your deductible is $200, and they only had to give out, $800, and they made $200 because originally you paid $1,000. Yes.
Well, and just to kind of course, obviously this is subjective too, because if you really are bullish, you've obviously, you have a little bit of cushion on the downside, fair enough, with the put, but son of a gun, your upside is capped. So again, if you're really bullish, right, you want that stock because your upside's unlimited. If you're not bullish, why are you in a position? Again, that's subjective. I'm not trying to say it's either way, but
that's correct, right?
Yeah,
so
let's
just say if you sell a put, right, the most you can make on that put until you get out of it or it expires is $300. Using that example I just said, right? That's the most you can make. But if you buy the shares at 100 and it goes up more than 3%, using that math, it has to go up $3 before it outperforms that selling the put, right? If it goes up more than $3 within that time frame of the expiration, then buying the shares, you're going to make more money. But I would argue that the probabilities are better on that selling that put than buying just the shares. Okay?
That said, I want to jump into a book recommendation that I want to provide this week. This book that I want to recommend is called More Money Than God. It's a book that I read years ago, but I think it's still a very, very good book. It's a great book on the history of the market and different trading strategies from famous hedge funds. Thank everyone for joining me this evening for this Wednesday night webinar. Just like last week, we're going to go over a topic. Tonight's topic is going to be on the 4 major option Greeks. So in the document, I am talking about with Vega right here. Hopefully you guys can see this. All right. So here I'm talking about that if volatility is low, how having short delta can offset the volatility spike when it occurs. So if you have, that's just for easy math, if you have 100 negative Vega, you can tell by that by looking on your platform. So if you're on the Thinkorswim platform, you have it set up with Vega, you just look at it, and just like you look at deltas, and whatever that number is, that's theoretically saying how much you're going to lose if the market spikes up. That's how much you're going to lose. But all of that can be offset by having time decay on your side, theta, positive theta, and having deltas. So if your deltas are short, right? If your deltas are short, that means you want the market to go down, right? And when volatility is spiking up, right? That means the market is going down, right? So delta is offsetting that directional move because you already have short delta. So you're winning at least initially on that move, right? Because you have short delta. So if you have 1 to 2% of short delta based on how much negative vega you have, then you can offset a big move in the market. And this is, obviously it's not static. It doesn't stay that way. It changes. That's why you always have to adjust your deltas. But when volatility is low, if you have some short delta, that will help you when the market starts to go down, because that's going to spike up volatility. So we hope that you enjoyed this vlog. And if you do, please consider subscribing to our channel and liking this video.